So we hit 9 o'clock. Why don't we just wait another minute or two just for stragglers to show up? And good attendance. Looking forward to a great session, everyone.
So Ken's going to use the screen for the slides, I assume?
Yes.
Yep, I have it up and ready to go as soon as we get started.
Ken, do you want to use share screen or you want me to run the slides?
I can do it. That's fine.
Okay.
Should I launch right now?
I'll just do a little kickoff and then I'll turn it over to you if that's cool.
That's fine.
ESOPs are very topical.
Always. It's a big hit.
Well, why don't we get started, everyone? Welcome. My name is James Morgan, and welcome to the Forbes M&A Group's latest installment in our webinar panel series. We're very pleased to present our latest session on the topic of employee stock ownership plans, or ESOPs. As I mentioned, my name is James Morgan, and I'm a managing director within the Forbes M&A Group's Salt Lake City team. The Forbes M&A Group is a mid-market focused M&A advisory firm specializing in sell sides and capital formation transactions with offices in Denver, Salt Lake, and Nashville. We are very excited today to introduce a strong panel of leading industry experts surrounding ESOPs. This is a novel method for company owners seeking to sell a portion of ownership, engage in a full exit of the business. It is an alternative to a competitive sale process. It's an opportunity for a liquidity event with long-term ownership by existing employees, and there are substantial tax advantages that could be available to business owners seeking an exit. We are very proud to have assembled our panel today, all nationally recognized leaders in the structuring and execution of ESOP transactions. With us on the screen, we have Ken Wanko. He's a friend of the firm and a managing director with SES ESOP Strategies, an advisory and execution firm that focuses on the ESOP space. We have Regina Carls, who's a senior member of JP Morgan Chase's ESOP team based in Chicago. And locally, we have Wally Lloyd, who's a partner at Denton's in Salt Lake and a leading legal expert in the ESOP space. He came recommended to us as someone who's forgotten more about ESOPs from a legal perspective than most people know. So we took that as a nod of approval. Our agenda today is to hold a 20-minute presentation by Ken on the ESOP structure, a discussion on execution considerations and long-term benefits of an ESOP across all company stakeholders. Following this presentation, we will be moderating a 30-minute Q&A answer panel with our team. Before I hand it off to Ken, throughout the presentation, please make it as interactive as possible. I think the best way to proceed, given this brave new world of Zoom webinars, if you could kindly ask any questions through my email, james.morgan@forbesma.com, which will be listed in the materials. We look forward to an informative and interactive session, and I'll now turn it over to Ken.
Great. Thanks, James, and welcome everybody. It's great to see you via Teams. I'm very pleased to be on this panel and session today with both Regina and Wally, two experts in the field, and I hope they help me out with this first part of the session, which is a presentation, a very general and broad presentation of the ESOP structure. There's a lot to cover in a short period of time, so I will jump right into it. And again, please ask any questions through James, and then he'll forward them on to us. So let me just jump right in and share my screen. Hopefully everybody can see the presentation.
Yes.
So we'll go straight through. We already went through the introduction, so I don't have to go through that again. But let's first start with what an ESOP is. And ESOP is an employee stock ownership plan. It is a qualified retirement plan that's governed and regulated by the U.S. Department of Labor and the IRS. It was officially formed when ERISA was created back in, it was 1974. But the ESOP structure has been used for many decades, actually going back to the 50s. So although it's a fairly niche structure for an ownership transition, it is well established and has been used many thousands of times over the last 60 years or so. Basically, the ESOP is a defined contribution plan, very similar to a 401k. But in the ESOP, there's typically no employee contributions. It is really just an employer contribution into the plan. The assets are held in a trust, which is the employee stock ownership trust. So the employees don't own the company directly. They own a participation interest in a trust. And that's very important when talking about governance and management of the business as an ESOP-owned company. The unique attributes of an ESOP is that the ESOP can borrow money and can engage in a transaction with a related party. And because it's intended to be invested primarily in company stock, the ESOP as a structure has evolved and become a tool of corporate finance. So it's become a very favorable structure and tool for executing an ownership transition. So an alternative to a sale to a third party. Very important, and for many people, they've heard of ESOPs and have heard certain aspects or myths about what an ESOP is or is not. And I think it's very important to clarify what an ESOP isn't. So the owner is not giving the company to the employees. The ESOP has a trustee that's a representative of the ESOP trust, the shareholder. And the ESOP it is in essence required to pay fair market value for the stock, the transaction. So the selling shareholder in an ESOP transaction receives fair market value for selling the shares. There's no giving the company away. The employees in an ESOP, as I said before, are not direct shareholders. They are participants in a trust. So they don't, by statute of law, get access to books and records of the company. What the ESOP participants are required to receive is basically an annual statement showing the value of their interest. So sharing detailed financial information with participants in an ESOP company is a choice by the management team and the board, not a requirement.
Yeah, and I'll just maybe add to that, Ken, if you don't mind. Our experience has been, and I think most companies will share that, while you begin to give a statement like a company will give a 401k statement, you begin to see the stock that each participant receives each year, and that stock has to be valued. That each year, the participants begin to understand that they're receiving stock in the company. It's not something that they've purchased. But to the point about sharing books and records, I know there's a lot of reluctancy initially to do an open book policy. I will just share that our experience has been with clients that the more you share over time, the more employees begin to understand really how they can drive value. And it is at the decision of the company as to how much information they want to share. But we have experienced that the more communication you have around ESOPs, the more the employees begin to understand, what drives stock price, the more they understand how they can impact that value and really get to the ultimate thinking like an owner.
Yeah, and I would actually second that comment, because this is an opportunity for management or the owners of the company to come in and get the employees to participate, in the sense that you can get them to understand that they do a better job, the company does a better job, their retirement does a better, winds up being in better shape as well. They are working towards their own retirement, and they actually have an impact on that because their participation in the company their actions in improving the company's bottom line makes a difference in their own retirement.
Great, thanks. A third myth is that in an ESOP transaction, the owner loses control of the company to the trustee. Although, you know, there's, I guess, different perspectives, and there's legal control versus effective control. In essence, when we think about what the buyer is or the owner of the stock, this trustee is typically someone that's not involved in the business, that doesn't have any operational aspirations or desire or honestly any experience in the specific company. So the buyer in the ESOP transaction tends to rely very heavily on the selling shareholder and existing management team to run the business as it had been run in the past. So when you compare an ESOP transaction versus a third-party sale, the selling shareholder has a lot more influence on the business post-transaction than typically would in a third-party sale. The fourth myth is that, you know, it's just way too expensive. That's just not true. The ESOP transaction is pretty much, I would say, on a similar, if not less expensive to accomplish than a third-party transaction. It does have some ongoing annual maintenance costs, including an annual valuation, and if there's an independent trustee, paying an independent trustee, but those are really minor in the ongoing scheme of things.
And typically how you're evaluating that is, you know, that the tax savings absorb those maintenance costs, especially in these 100% ESOP transactions. I used to use the example of IRB financing. The cost of establishing an IRB should pay for itself within the first 6 months of the transaction. Depending on the size and complexity of the transaction, your tax savings will be, you know, paying for those costs very quickly.
And we'll go through all the tax benefits of an ESOP transaction in a bit, but that'll become exceptionally clear when we go through those. So what is an ESOP transaction? How does an ESOP affect a transaction or buy shares from a selling shareholder? And so this slide really goes through the mechanics of an ESOP buyout, basically. And in essence, the ESOP is a trust that doesn't have any assets when it comes to the table. So the only way that the ESOP can buy stock is to borrow funds in almost all situations. But the ESOP has no assets, so it can't necessarily borrow directly from a lender. So how a transaction typically goes is, and we'll try and keep this high level, but basically the company borrows funds from a lender, and then the company turns around and lends those funds to the ESOP trust to effectively make the purchase of the shares from the selling shareholder. So now you have really two different loans. You have a loan from the company, from the lender to the company, and then you have a loan from the company to the ESOP. Those are two distinct loans with different terms and different conditions, and they're handled differently. But what happens is that over time, the company will pay back the loan to the lender, and then over a longer period of time, typically, the ESOP trust pays back the loan to the company. But the ESOP can't necessarily pay back the loan because it's not receiving any funds. So what happens is the company makes a contribution to the ESOP each year, and that is basically a retirement contribution, just like the company would make a retirement contribution to a 401k plan. But what then happens is that the ESOP takes what it's received in the contribution from the company and immediately pays that back to the company, and that is the repayment of the original loan. So over time, the company makes a contribution to the ESOP, and the ESOP just turns around and pays that back to the company to repay the initial transaction loan. And the company in that gets a tax deduction for making that retirement contribution. So if you think about it in the long run, in essence, the company gets a tax deduction for the entire value of the transaction. So really effectively makes the transaction impact much less because of that effective tax deduction.
So I would just add to this slide, it is not a windfall for the employees here. The employees do not have receipt of that stock day one. It's sitting in a suspense account that's encumbered with that loan. And so each year, as Ken mentioned, as a contribution is made to the trust, and that cash flow makes a round trip back to the company to repay that, what we call the internal loan, stock is then allocated. And that allocation is based on a benefit level that you're setting at the front end. So you look at these as two transactions, a capital transaction between the company and the lender, and a compensatory with the ESOP.
If you want to think of it as, because there are multiple loans going on, and the loan between the company and the outside lender and the loan between the company and the ESOP effectively offset each other in terms of interest. That's if you're doing a mirror loan, and as has been mentioned, sometimes the loans don't exactly line up, but you're basically getting an offsetting deduction for the income that you have to recognize on the interest on the loan. But what you're getting is a full deduction for the entire contribution that you're making to the ESOP. To the extent the loans tend to mirror each other, what you're basically getting is a deduction for both principal and interest on the loan.
And I would say that something that are not widely used today because of the allocation of stock. External loan is not an area where it's an internal loan is a much larger.
Hopefully, we're getting a lot back there. I don't know if someone else is on mute. All right, we'll continue. Is everyone else getting the feedback?
No, but you're breaking up a little bit. It's not real clear sometimes.
Okay. I will be closer to my microphone. It seems like I'm muted.
I'm hearing an echo.
So we'll quickly go through. We only have about 5 or so more minutes on the presentation. So basically, a leverage buyout is, the pros are it's very tax efficient and it's very flexible. And we'll go through the tax benefits very quickly, but the flexibility comes into play with the amount of stock sold. There's a wide range. You can sell anywhere from honestly 1% to 100% to the ESOP. Timing, there's a lot more control as far as timing of the transaction, timing of exit for a selling shareholder. It can be staged over a long period of time, or can be done immediately. You can treat different shareholders and different sellers differently in a transaction, and you can combine it with other management incentive plans. So it's a very flexible structure that has a lot of unique attributes that you can tailor to the goals and objectives of the company and the selling shareholders. So basically, on the tax efficiency, there are several tax benefits to an ESOP transaction. We'll go through the two major ones. The first is what's called Section 1042 of the Internal Revenue Code, which allows a selling shareholder to defer their capital gains on the transaction so long as they reinvest the proceeds in qualified replacement property. So very similar to Section 1031 real estate exchange. But there are a few requirements in the transaction that need to be adhered to for the selling shareholders to get this capital gains deferral. The first is that the company at this point must be a C corporation at the time of the sale. So when we go through transactions, we structure company, because most companies are S corporations, but we structure it in that they'll flip back to a C corp, affect the transaction, and remain a C corp for a period, the holding period. So it's basically 5 tax years, and then flip back to an S corporation. So it's a requirement that we deal with all the time in structuring transactions. The seller must have a minimum 3-year holding period in the stock. And then one of the major requirements is that the ESOP must own at least 30% of the company immediately following the transaction. So this 1042 capital gains deferral sets a minimum threshold for selling to the ESOP. And then ultimately the seller must reinvest the proceeds in qualified replacement property. And in general, QRP is in essence stocks and bonds of US domiciled companies. Very broad range of qualified replacement property. And then there's a whole, I guess, cottage industry set up around structuring QRP investments and then structuring the ability for the selling shareholders to monetize that and get the liquidity out of the transaction.
Well, one thing to mention here, Ken, it's not mandatory that you use the exact same dollars that you received from the sale of shares to buy the qualified replacement property. There's a time frame during which you have to purchase that qualified replacement property. It's a 15-month window that actually starts 3 months prior to the date on which the sale transaction occurs. So you have a window of time during which you can acquire qualified replacement property. You report that to the IRS on your tax return. You're making a specific 1042 election on that return when you do this. And then you have a 12-month window following the date of the transaction in which to complete the purchase of qualified replacement property, which you again report.
Correct. So flipping over this is an effective illustration of the benefit of taking advantage of 1042, and it's really just a deferral of the capital gain. So in this transaction over to the right, you see, okay, there's a comparison between selling to the ESOP for $16 million and selling to a third party for a larger amount, $18.5 million. But if you go down the table, given the gain on the transaction, you'll see that with the savings of the capital gains taxes, the after-tax proceeds, which everyone should be looking at after-tax proceeds of a transaction and not pre-tax, but the after-tax proceeds in a sale to an ESOP when you elect 1042 is ultimately greater than the proceeds you'll receive from a sale to a third party. And this only covers federal capital gains, doesn't include state capital gains taxes. And in almost all states, 1042 is recognized, and it basically makes the election of 1042 an even stronger proposal versus a third party sale. In the end, a lot of this is structured so that the QRP, I guess, portfolio is structured so that it tends to outlive the selling shareholder. And as taxes are now, you get a step up in basis at when the proceeds go into the estate. So by doing that, you eliminate the capital gains on the transaction. We'll talk about proposed tax changes coming up in the Q&A session.
But you can, just to add to that, you can sell a QRP at any time and trigger the gain. And so if you hold it to death and get a step up in basis, that's one approach. There's also the approach to have an active managed portfolio where you may sell a QRP, trigger the gain, and offset it against a loss of some other security in your portfolio. So they're very flexible.
The other major tax benefit in the transaction is when ultimately the company becomes, well, it doesn't have to become 100% ESOP owned, but when the company becomes 100% ESOP owned and converts back to an S corporation structure, the ESOP is a tax exempt trust. So ultimately, if the ESOP is the sole shareholder in a pass-through entity, an S corporation, the company becomes a tax-free entity and does not have to distribute anything for tax purposes. So that provides a very, obviously the most efficient tax structure of a corporation, and allows the ESOP company to, one, pay down debt quicker, reinvest in the business, or ultimately go and look at growing through acquisition. The company doesn't have to be 100% ESOP owned, but the percentage of the ESOP ownership is effectively tax exempt. So another illustration, very simple illustration, a company paying taxes and a company not paying taxes. So in an ESOP situation, you eliminate that tax liability for the company, and again, increase cash flow for the business for whatever corporate purpose is deemed the most important. This slide just goes through quickly a little bit of the structure. Again, the ESOP trustee is the representative of the shareholder and elects the board of directors. This is where the structure is a little bit circular in that the board of directors actually appoints the ESOP trustee. So there's a bit of a circularity in the corporate governance here. But what I really want to show here again is that the ESOP participants, the employees, are outside of this chain. They don't have day-to-day impact or share or voting rights or impact on the day-to-day management decisions of the business. That's really the responsibility of the board of directors and then management. So again, by becoming an ESOP-owned company does not mean that the company is run by the employees. It's still a company. It still has a board of directors that is responsible for overseeing the strategy and execution of the business.
I ought to mention that there is a pass-through voting right that is mandated under the Internal Revenue Code under some limited circumstances. And those are typically situations where there's a major change in the corporation, such as a reorganization or a merger or a sale of substantially all the assets. In those circumstances, there is a pass-through voting that is mandated under the statute, but those are not the typical ongoing transactions that a company will deal with, and that just the day-to-day operations of the company do not require any pass-through voting.
And I would just add that if you talk to trustees, they're there for the benefit of the employee participants. They're not there to run the company. They don't want to sit on the board. They have fiduciary liability. They don't want to step into shareholder liability. So they're essentially hoping that the post-transaction, the company is running as it did pre-transaction for the benefit of employees.
A lot of times in that situation too, the ESOP trustee will be a directed trustee, and will take direction from typically a committee that is established by the board, and that committee may actually be the entity that will give the direction. So to the extent the trustee is obligated to vote shares, like to appoint board director members and that kind of thing, then that direction comes from the trust committee that the board actually sets up.
Just quickly through benefits to the company and benefits to the employees. There is a lot of research that has been done on ESOP-owned companies over the years, and it all points to the results that employee-owned companies tend to be stronger. Productivity improves, higher job growth in employee-owned companies, higher return on assets, and higher revenue growth as well. And this is all through the National Center for Employee Ownership, the NCEO, which is a national organization that deals with employee-owned entities. In addition, benefits to employees. Employee ownership tends to keep employment in the business that's part of. 4 times less likely to be laid off in the 2007-2008 recession, and also builds community wealth. And I think this is one of the major benefits that comes out of employee-owned companies, is that ultimately the employees have a much larger retirement account than they would otherwise have if they were employed with a non-ESOP-owned company. And their wages tend to be a little bit higher. So overall, the benefits to the selling shareholders, the company, and the employees all point to a very, very positive result.
And just add to this one that it's very common that the ESOP is an addition to the 401k plan. Most companies continue to retain the 401k and allow employees to make their deferral, and they redirect that company match to an ESOP. So to Ken's point, the benefits tend to be fairly strong in ESOP companies because they do have the combined benefit of the ESOP and the 401k.
Okay. And the last slide that I have is just from our perspective, from SES perspective, the ideal ESOP candidates, there tends to be a minimum number of employees that you want to see. Profitability is key in an ESOP-owned company because it does need cash flow to support the transaction debt. We tend to look at transaction sizes a minimum of $2 million. And really, that's just because there are professional fees associated with effecting an ESOP transaction, and you need a minimum transaction size to justify those fees. But ultimately, an ESOP is a viable transaction strategy for virtually any industry, most size companies, and it really depends on ultimately the goals and objectives of the selling shareholders and what they want to achieve in a transaction. And that's it for the presentation. Now we'll move on to Q&A and discussion panel. I will stop sharing my screen.
Actually, Ken, if you could share it and then move to the next slide, that'd be great.
I'm going to just leave it with this. Okay.
Yeah, it's great. So thanks a lot, Ken, and to the panelists, thank you very much for everything. That's a really inclusive and thorough presentation. So while we have kind of the remaining half hour, why don't we just go around the horn and pepper you with questions, and please, audience, let's make this as interactive as possible. If you'll see at the bottom of the slides, you can send me an email to james.morgan@forbesma.com, and we've already gotten a couple emails in, so I'll just so I'll start off with one from Joe, and it's, I think, directed towards Ken, and the question is, how does the ESOP process, if I'm a business owner, what, if I'm reading it correctly, how does the ESOP process rate versus just a competitive sell side where you're going out to a bunch of folks in terms of timing, potential valuation, impact on management's time? How does the ESOP process work relative to a regular sell side? And can you give some examples of industries where the ESOP structure has been very effective?
Sure. So, an ESOP transaction is a sale to an independent company, an independent entity. So it is somewhat similar to selling to a third party. There are definitely unique attributes to an ESOP transaction that I would say make it an easier transaction to accomplish. First of all, as I said before, the ESOP is the trustee of the ESOP is not an operational entity. They are not looking at the business in any kind of strategic sense. So they're typically their due diligence process in an ESOP transaction is a little bit less intrusive than in a third-party sale. Second, post-transaction, the ESOP, as we said in the presentation, the ESOP trustee does not want to get involved in operations of the business. So very different than selling to a strategic party or a private equity group. There's really no desire from the ESOP trustee to be involved in day-to-day management, to set strategy, to change direction of the business. So again, I'd say that the major difference is that post-transaction, the existing management team and ultimately the selling shareholders in many instances still have effective operational control of the business and strategic control of the business going forward.
And I would just add to one of the big differences I always say is the timeline. In a third-party sale, the longest time frame tends to be that negotiation back and forth on the price, whereas in an ESOP, you have a third-party valuation that's setting that value. So that tends to reduce the timeline to execute. And it's not uncommon, quite frankly, for companies to go down what we call a dual track, where they're looking at a sell side in comparison to an ESOP and evaluate the merits of both of those transactions. So to think of it as a sell side type transaction structure is appropriate. There are just some differences in timeline and obviously tax benefits, and it's an internal transaction versus an external transaction.
Thanks, Regina.
I do want to emphasize, however, that the valuation of the company is a critical issue in any ESOP transaction. Ken mentioned early on that that this area of retirement planning is monitored by the IRS and the Department of Labor. The Department of Labor in particular has a significant interest in making sure that these transactions are not manipulated inappropriately. And so it is very critical in their view and their thinking to make sure that if the ESOP is buying shares of stock, that the ESOP pays no more than fair market value for those shares. And because this is always, we're talking here about closely held companies, fair value for the shares is a determination of what the company is worth. Well, that's basically a determination by the appraiser. That's not an exact science, but there are some fairly clear defined rules as to how that appraisal is determined and what processes are undertaken and how that valuation is done. It is critical that the appraiser who is used in this case is someone who is experienced in the area, and the choice of the appraiser, the choice of the independent fiduciary who will be acting on behalf of the ESOP to evaluate the transaction and decide whether or not to go ahead with it is also very critical as part of the process.
Thanks, Wally.
And yeah, and Wally, I don't know if we did go through this in detail in the presentation, but in a typical ESOP transaction, an independent trustee is hired to be the buyer, and then that trustee will then hire their own financial advisor and their own attorney to negotiate the transaction for the buyer. And so that's how it's set on their side. So the trustee will hire the financial advisor who will then do their independent valuation. Typically in our transactions, and we will represent the selling shareholders or the company, and we will have done our valuation on our side so that there's a sense as to what fair market value is. So I'd say in a typical ESOP transaction, there is a good sense of value from the very start as to what the transaction will trade at, in essence.
It is certainly the case that the selling shareholders have a fairly good idea of what they think the company's worth. Sometimes you do run into some shareholders who have a little bit of a pie in the sky approach to what they think their company's worth, especially if they've sort of grown that company from the beginning and it's been their baby. Then you get to the point now where you're going to make the transaction happen. But when that occurs, you have to remember that you are getting someone who is totally independent, who will be representing the interests of the ESOP. And that appraisal has to be done on an independent basis, or the Department of Labor will come in and say, we don't think you did this correctly.
Just looking at questions, I'm just looking at my email stream. Regina, there's one for you about the lending structure that underlies an ESOP. And the question really is, how does the leverage fit within other forms of debt, either junior lines of credit, ABLs? And are there aspects of a company that, cyclicality, expectations of growth, working cap needs that will impact, the ability to, the availability of leverage in an ESOP deal?
Sure. So I always like to dumb it down by saying, think about an ESOP as a dividend recap with tax benefits. And so as we, as a banker, we're going to evaluate debt capacity of a company in an ESOP context, similar to what we're going to be evaluating it in a non-ESOP context. But there are incremental tax benefits in these structures. And so the most common structure we see today is the 100% S Corp ESOP. So as Ken mentioned, if you are an S corporation that's owned which is a pass-through entity that's owned by an ESOP, which is a tax-exempt trust, you don't pay taxes to the extent of the ESOP ownership. So if you're 100% ESOP owned, you're no longer paying any federal income tax, and in most situations, no state income tax. And so when you think about that, what cash flow that used to go outside to pay taxes is now remains, within the company. And so from a structuring perspective, we're going to be evaluating what kind of senior leverage we can put on the business And we will be including, obviously, debt capacity will include working capital needs of the company, any term financing that's in place today. And so the evaluation will be what kind of incremental debt capacity is there to support a transaction. Many of these structures are situated as, especially in the 100% transaction structure, with senior and seller financing. There's certainly the ability to bring in mezzanine to get additional cash at close. But a lot of times we're finding sellers are saying, I'll take back a note from a company that I understand. It's going to be deeply subordinated to the senior lender. So we will not allow payments on that seller debt initially until we see the leverage get down within a certain leverage profile. We'll be evaluating collateral similar to as we would in a non-ESOP context. They're, depending on the size, the volatility, all of the same underwriting criteria we would use for specific industries will be applied to an ESOP context. So I would, that's why I go back to the fact that, think of it as a dividend recap. You're putting debt on the books. There's an increased liability. And then you have, in 100% context, subordinated debt that sits below. But because of these tax savings, we found that traditional structures are on the external financing. That external loan Ken mentioned is normally a 5-year term loan. The internal loan will be based on the term, the level of benefits that you're trying to set. So that internal loan may be a 30-year internal loan. We find that typically within 3 years of our senior financing, we're in a position to begin to recap that seller note because of those tax savings. And if, depending on the situation up front, depending on the funded leverage out of the gate, there may be ability to share some of that with the seller. It's very specific. The underwriting is very specific to a company, just like it would be in an external financing, but it is incremental debt. So it's very important. We're working with companies to say, let's look at the forecast of the company. How is this debt going to impact the ability to grow? You don't want the tail wagging the dog. You don't want the ESOP directing the company and how they spend their money. And so you need to make sure you're incorporating that into that financial forecast, understand the tax savings that come with the ESOP structure, and that you have adequate debt capacity or dry powder, if you will, to support the ongoing operations of the business.
Yeah, but if you think about it, the company, and I think Regina's explained it very well, but the company is basically paying for the stock out of its cash flow. And it's also doing that by making contributions to the ESOP on an annual basis. And there are some limitations under the Internal Revenue Code on the amount of those contributions. And that's a function of the payroll of the employees of the company. There's some limitations on the maximum amount of contribution that the company can make. So you do want to be in a situation where you have carefully examined your payroll, what the potential for company growth is, how that payroll is going to, or that potential limitation on that contribution is going to impact the debt. You're always going to want to make sure that you're in a position that you never have to worry about whether the contribution that you're making to the ESOP is going to be tax deductible.
Here's a question from Stuart. So the hypothetical is you have a partial ESOP liquidation and there's a family with multiple shareholders. And when you engage and execute the ESOP, you buy out some but not all family members. What is the mechanism for remaining family members to buy out the ESOP trust down the road if they'd like to consolidate back into their original closely held family structure? That's a jump ball for the crew.
I'll share one example. We've had this conversation with companies. I had one actually, I think in that market not too long ago, where you've got a business that wants to remain a family business. ESOPs can be used for a lot of different reasons. I mean, you've seen it to buy out a partner. We've seen it, unfortunately for buying out in a situation of divorce. At the end of the day, you can sell any level, as we said before, 1% to 100%. It's a qualified plan. And how you buy back that stock can determine the impact long-term to the ESOP. So to the extent that let's say you sold 30% to the ESOP, you created a benefit plan, you've allocated stock to your employees over a period of time. If the company, you're going to have an obligation, the sponsored company is going to have an obligation to buy back that stock due to triggering events, death, disability, retirement, and termination. If that stock is bought inside the ESOP, what we call recycling, it continues the ESOP in perpetuity. If you were to buy it back as a redemption, as a company redeems the stock, that could be, slowly unwinding the stock over time. So we have seen companies where they've used it for estate planning purposes to create, a liquidity tool, deliver a benefit to employees, and then over time redeem that stock, and that the stock would unwind.
Okay.
We actually had a situation a couple of years ago where the company that we were dealing with had been founded by Grandpa, who was gone, and Dad was gone, and son was now at retirement age. But over the years, as the family had grown, there were over 300 shareholders, none of whom, with the exception of one son, was even involved in the company anymore. And this actually created a really excellent situation for transferring what a lot of people who were all family members but had no interest in the company wanted to unload their stock. We were able to create the ESOP. The employees of the company became now the management, because that's where the company had gone. And the family members, who all had sometimes fractional shares, were able to sell them all, get all that through the ESOP. And the ESOP now became the owner of the company. It was an S corporation. It was actually in the construction industry. And the advantage to that at that point too was because there's the special tax benefits that we've talked about. The company's bonding capacity went way up, and they became far more competitive. Actually, it was a win-win for everybody.
And I think in the end, kind of going to the specific question, the ESOP is just another shareholder. And so ultimately, again, because the ESOP trustee looks at it for the benefit of the participants and looks at their investment on a financial basis, if down the line, say there were 3 family members and the ESOP bought from one, if the other 2 family members want to buy back and basically terminate the ESOP and buy those shares, that is completely open, and would just be a negotiation between the 2 remaining family members and the ESOP trustee. We'll have to make the transaction viable for the ESOP trustee, and so that means paying either probably above, whether it's slightly above or a decent amount above fair market value, but ultimately that's how that transaction would go.
Thanks, guys. I have a question here, so get your pencils ready. This will be this has a preamble to it, so it'll require some thought beforehand. So the exam question is, the preamble is, I understand, this is from Anya, in order for the ESOP transaction to qualify for Section 1042, the S Corp has to convert to a C Corp, and the ESOP needs to own at least 30% of the company after the transaction. Is there a way to set up the ESOP in a way that the S Corp does not have to convert to the C Corp, and the ESOP can own less than 30% of the company, even if the tax benefits might not be achieved? Very thorough question.
If you're asking 1042,
right.
Oh, that's go ahead.
I was just going to say, yes. I mean, you can kind of going back to it, you can sell as much or as little to the ESOP and remain an S corporation. But in that case, if you go below and don't hit the requirements, you just cannot take advantage of the Section 1042. So we have a client right now that is an S corporation, very strong cash flow business. The owners are not interested in 1042, so we're structuring a transaction where they're just going to sell 20% to the ESOP and remain an S corporation post transaction.
But once you, and further to that point, today 1042 only extends a C corporation. There is legislation out there trying to extend the same benefit to S corporations. Has not been approved yet. But to Ken's point, any sale up to 30% would not qualify. Once you hit that 30% and beyond, it would qualify for 1042. And really, it's an assessment of your basis in the company. If you've got, if you have a low basis, obviously 1042 can be very compelling. If you have a high basis, it may not. And so you really got to assess the individual tax position of shareholders going into the transaction, and if it makes sense to even convert.
Guys, I'm just looking at the clock, and I'm trying to get to the high level stuff. So the topic that's on every business owner's mind, and we're getting calls on it multiple times per day, is everyone's talking about capital gains law, legal changes. And given the expectation of a potential regulatory change, is an ESOP beneficial to that? Does the timeline meet someone's ability to execute in time? Because everyone's trying to do a deal before the end of the year. What are the pros and cons of an ESOP within that context?
Well, clearly, one benefit is 1042 if you're looking at the capital gains issue, because if you are just selling your stock and you're not doing it, you're not selling that stock to an ESOP, then on the sale of those shares, you have capital gains you've got to recognize, and whatever that capital gains rate is, that's what you pay. There are some ways that you can structure those sales to be over a period of time, and you can take installment. You can recognize the income on an installment basis under certain circumstances. There are limits on those. But beyond that, 1042 offers you the best opportunity to sort of wait out, I guess, maybe one way to look at it, where Congress is going with 1042. The idea of capital gains taxes moving up and down, that's happened before in the past. And when you purchase qualified replacement property, the advantage there is you now control when you're going to recognize the sale of that stock and when you're going to pay capital gains taxes. So to the extent that you can take advantage of 1042, that does give you an opportunity to sort of moderate and monitor when you're actually going to recognize taxes and what's going to happen, depending upon who's running Congress and their views on taxes and capital gains.
Interesting.
Yeah, and I would just add that the beauty of the ESOP, as we spoke about earlier, is that it is a shortened timeline. It tends to be a shortened timeline because of the valuation being, setting the value of the business. So yeah, I would just encourage, we are flooded this year. I know I've talked to many practitioners, and Ken shaking his head. We are flooded with new deal requests looking at ESOPs and the ability to finance it. You can absolutely execute an ESOP transaction this year. I would warn everyone that when you try to wait till the back end of the year, it becomes more difficult. Everyone's trying to push out a transaction by the end of the year. The number of practitioners, the timeline can get extended just because of what everyone has on their plate. So if you're looking at entering into something like this and evaluating this, the sooner the better.
Thanks, Regina.
You want to pull the trigger pretty quickly. There is a timeline involved. There are some things that have to be put in place, and you don't want to get down to the short strokes and find that you haven't crossed all the T's and dotted all the I's. And as I've mentioned before, the Department of Labor does maintain an interest in these transactions. You do not want to engage in one of these transactions and try to short circuit it or take shortcuts that will get you in trouble down the road.
Thanks, Polly. Ken, here's a question for you. If one of the business owners that's on this call right now was saying, you know what, I'm interested in thinking about an ESOP and selling maybe 12, 18 months from now, what would you tell them in terms of preparation, identification of key process issues, compilation of diligence materials? How would you tell them to get ready and what to focus on?
Sure. Well, I think, as we've said, the ESOP transaction is somewhat similar to selling to a third party. So I think the advice is very similar in preparation whenever you're looking at an ownership transition event. And that's, I would say, probably the primary processes or parts of the business to prepare are ensuring that there's a management team in place that's capable and qualified to run the business post-transaction. I think that is critical, especially for an ESOP transaction, because again, as I've said multiple times, the ESOP trustee is not an operational entity. They're not going to help with operations. So that's one of the things that we really try to focus on with our clients, is ensuring that either the business owner is going to continue in the same capacity, or that the next layer of management underneath is prepared and able to manage the business post-transaction. Then, that could take 12, 18 months. That could take several years to get that preparation in place. So the sooner the better to start talking about and thinking about management succession planning. The second, I think, critical item for an ESOP transaction, because it's a very financially driven transaction, is ensuring that the financial books and records, procedures, and underlying reporting ability is robust and can withstand a due diligence process. Even though I've said before that due diligence in an ESOP transaction is slightly less intrusive than in a third-party sale, it still requires a lot of reporting, analysis, financial analytics and reports. And so, ensuring that you have a financial team or financial systems in place that can withstand a lot of scrutiny is critical for a transaction. And then, on the ancillary side, just talking to advisors like yourself, James, who've been through transactions many times before and understand what drives value, what drives success in a transaction. Each company has its risks, has its shortcomings, has its maybe its flaws that it can bolster up in the months and years prior to going out for a transaction.
That's fantastic. So before we sign off, this panel has been absolutely fantastic. I just want to go around the horn. Sarah was kind enough to send us one last question, and maybe it's a good way to end it off, and I'll ask each of you. If someone wanted to pull the trigger on an ESOP right now, in terms of execution, what has to go right and what can go wrong? So I'll just go around the horn. Regina?
I think Ken spoke to it. I would just add that, part of the financing aspect of it is understanding what kind of debt capacity the company has to support the transaction. So their advisors, we do, debt capacity feasibilities to show how a potential structure can look within the overall capital structure. To Ken's point, making sure your books and records are in order. And, we're looking at to make sure, anytime you transition a business, do you have that management team there that continue to support the business ongoing? Because the cash flows pre-transactions, we want to ensure are there post-transaction to help deleverage the business. So what can go wrong? I think what happened, in the past, we've seen companies that have, pushed the envelope with, too much leverage out of the gate and didn't have that dry powder, so to speak, to support the ongoing operations. Understand the volatility that can take place in an industry. We understand, the goal selling shareholders want to maximize, value at close. But there is the flexibility in these financings, and you want to make sure that the company is not, like I said before, run by the ESOP. So the other thing I would say is make sure you're working with qualified advisors, because, as Wally mentioned, it is regulated by the DOL and the IRS, which I don't look at it as a negative unless you are not using qualified advisors, where you can get into trouble. So I would test, your advisors, understand what their experience is, have them give you representative transactions, how recent those transactions, have they been tested by the DOL? It used to be that it was not necessary that it would necessarily going to be tested. The DOL would not necessarily test the transaction. Now we can say, expect the DOL to come in and take a look at the transaction with the first 3 years. So work with qualified advisors.
Thanks, Regina.
And
Wally,
the DOL always shows up with 20/20 hindsight. And so it is, I want to underline and emphasize that point, that it is really necessary here to make sure you're dealing with qualified people who have some experience in this area. This is not a place for neophytes. This is a wonderful way to handle corporate financing. This is a wonderful way to transition selling shareholders, maintain management, move management, all those kinds of things that you might want to set up for your company. But you do want to make sure that you are doing it correctly and you're following all the rules. You're not trying to take any shortcuts and cut corners.
Thanks, Wally. Ken, final?
Yeah, I think I'd like to go just a little bit kind of really high level and say that although we've been talking about how the ESOP is these bees and the best thing ever, it's not in all situations. And so the first thing that we do, and when we talk to clients, is we go through and identify what the objectives and goals of the transaction are, and that's key to determine whether an ESOP is the right structure or not. Because what can go wrong is that you get to a point and the selling shareholders look at the structure and say, no, this is completely not what I want in exiting the business. And so to make sure that it lines up with what the shareholders' objectives are and what they want from their legacy, what they want in liquidity, because the ESOP is not going to provide 100% liquidity at close. It's just not. So so that's what I would think is the most critical item in this part, is to understand and match up the goals.
Well, thanks everyone for your insight. I thought that was an absolutely tremendous presentation and panel. At the top of Ken's presentation, we can circulate everyone's contacts. So you have the leader in terms of legal, in terms of ESOP execution, you have the leader there, and you have a very, very senior member in the leading bank for ESOP lending. So hopefully across the participants this morning, there's a great cross-section of who can be helpful if you want to reach out and further investigate this type of transaction. So thank you for your time this morning. Please reach out at any time, and I'm happy personally to introduce you to any of the panel members, and have a great day, and thank you for your time.
Thank you.
Thank you.
Thanks, everybody. Take care.